The Psychology of Investing. Chapter 12. Self-Control and Delayed Gratification.
The marshmallow test captures a choice investors face all the time. Take a smaller reward now, or wait for a potentially larger one later. In markets, that smaller reward often shows up as an early gain that feels good to lock in. Selling can feel safer because it turns an uncertain paper profit into a definite result. But many worthwhile investments need time, and the best part of the return may arrive much later than your emotions would prefer. That is why delayed gratification matters so much in investing. The challenge is not just understanding this idea intellectually, but recognizing the impulse in real time when a quick profit appears. Early profits feel tempting because they offer emotional relief as much as financial reward. The moment you sell, uncertainty drops, and your brain gets to say, "I won." That sense of safety can be powerful, especially after the anxiety of watching a position move around. The problem is that relief is not the same thing as a good decision rule. A stock can still have meaningful upside, even though selling right now would feel satisfying. If you do not separate emotion from process, quick profits can train you to exit good ideas too early. Patience can add value, because investment returns rarely arrive in a smooth, predictable line. Many stocks spend long stretches doing very little, then produce a large part of their gain in a short burst. If you sell during the quiet period, or after a small rise, you may miss the move that mattered most. That does not mean every investment deserves more time. It means some valid ideas need room to develop before the market recognizes them. Patience is valuable because markets often reward endurance, but only when endurance is tied to a sound reason for owning the investment. Patience in investing is not the same as refusing to sell no matter what. Delayed gratification only makes sense when the original reason for buying still holds up. If the business is performing as expected, the balance sheet remains healthy, and the outlook still supports your thesis, then price alone may not be a good reason to exit. But if new facts have weakened the case, holding just because you do not want to admit you were wrong is not discipline. That is stubbornness. The key question is simple. What changed besides the price? When the urge to sell appears, structure helps. Start by naming the urge directly. I want to sell because this gain feels good, or because I'm afraid it will disappear. Then go back to your original thesis and remind yourself why you bought the investment in the first place. Compare the current price with your intended target, rather than treating any gain as enough. Review your pre-planned sell rules so you are acting from a standard, not from a mood. And if emotion is running high, step away for a while before making the final decision. A simple process creates just enough distance for judgment to catch up with impulse. Susan's example shows how strong this temptation can be, even after a modest gain. She bought 100 shares at $50, so she invested $5,000 in total. Just 3 weeks later, the stock rose to 54, creating an unrealized gain of $400, or 8%. That is enough to feel meaningful, especially over a short period. Many investors would immediately think, why not just take the win? The emotional pull comes not only from the money, but from how quickly it appeared. Before selling, Susan asked the right question: had anything actually changed in the business? She reviewed the facts and found that the company's government contracts were still in place. Another new deal had been announced, and there was no major negative news. In other words, the price had moved, but her thesis had not weakened. That distinction matters. A rising price can create urgency, but if the business case is still intact, price movement alone may not justify an exit. Her decision became more thoughtful the moment she shifted attention from the chart back to the underlying reason she owned the stock. Susan then compared the small reward in front of her with the larger goal she had originally set. Selling at 54 would give her a $400 gain, but she believed the stock could reasonably reach 70, which would mean about $2,000 in profit. Framed that way, the choice became clearer. Take a modest reward now, or stay aligned with the bigger opportunity she had planned for. She chose to follow the plan rather than the urge. Later she sold at 72 and earned $2,200. The lesson is not that waiting always pays off, but that comparing both outcomes can keep you from surrendering long-term upside too cheaply. The mistakes here are subtle, because they often feel like discipline in the moment. Investors can become attached to small gains and start treating every profit as something that must be protected immediately. Others confuse patience with stubbornness and keep holding even after the thesis has broken. Costs and taxes also matter, because frequent selling can quietly erode returns. There is also the dangerous assumption that you can always sell now and buy back later at a better price. In practice, that kind of timing is hard, and many people end up paying more to re-enter than they expected. One of the best ways to strengthen delayed gratification is to prepare before emotion shows up. Write down your entry price, set a realistic target that reflects why you bought the investment, and calculate what success would look like if that target is reached. Then also calculate the smaller profit you would have after a quick gain, such as 10%. Seeing both numbers side by side makes the trade-off concrete. Finally, write a sentence explaining why you would still wait if the business remains on track. When temptation arrives, you are no longer improvising under pressure. You are returning to a decision you already thought through, calmly. Watching prices constantly can feel responsible because it creates the impression that you are staying on top of your money. Many investors equate monitoring with control, but markets produce endless small movements, and most of those moves do not reflect a meaningful change in business value. If you expose yourself to that noise all day, your attention naturally shifts away from long-term judgment and towards short-term reaction. What feels like vigilance can quietly become a habit of emotional overexposure. The goal is not less awareness, but better timed awareness. Frequent monitoring leads to impulsive decisions because the brain does not process every price move neutrally. A small decline may be temporary and insignificant, yet it can still feel like a real loss in the moment. Since losses usually feel stronger than gains feel good, repeated checking creates repeated stress signals. Over time, that emotional strain can make a sound investment feel more dangerous than it really is. The urge to reduce discomfort then pushes people toward unnecessary selling or constant tinkering. In that sense, too much monitoring can manufacture problems that were not there to begin with. This pattern is often called myopic loss aversion. Myopic means short-sighted, and loss aversion means that losses feel more painful than equivalent gains feel rewarding. Put those together, and frequent viewing makes investing feel riskier because you notice many more short-term losses. The investment itself may not have changed at all, but your experience of it becomes more stressful. Someone who checks once a month may see a broad upward trend with occasional dips. Someone who checks every hour sees a stream of little setbacks, and each one invites emotion into the process. There is also a hidden cost to checking that has nothing to do with markets. Every quick glance interrupts concentration, and the mental reset often lasts much longer than the glance itself. If you break focus repeatedly during the day, those interruptions add up into lost productivity and scattered attention. That time could have been used for work, research, rest, or deeper thinking. In other words, Frequent checking does not just change how you feel about your investments. It changes how you spend your day. Attention is a valuable resource, and the market is very good at taking more of it than it deserves. The solution is not to ignore your portfolio, but to replace impulse with routine. Choose a fixed time when you will check, such as once after the market closes. Turn off app notifications and email alerts, so prices are not constantly asking for your attention. Keep the review short, maybe 5 minutes, and treat it as observation rather than a call to action. This changes the relationship. Instead of the market deciding when you look, you decide. A simple routine reduces triggers and gives your mind a more stable rhythm. A scheduled check works best when it has a clear purpose. During that look period, review closing prices or your portfolio summary and make a brief note about what changed. The goal is to observe patterns, not to interpret every move as a signal. A stock being down for the day does not automatically mean anything important has happened. By recording changes without trading on them, you train yourself to see movement without treating movement as instruction. That small distinction helps restore discipline. It also helps to create space between feeling and action. After checking, write one sentence about how you feel, even if it is as simple as, "I feel uneasy because the position is down today." Naming the emotion weakens its power a little by making it visible. Then wait 24 hours before placing a trade. During that pause, revisit your original thesis and ask whether anything fundamental has changed. This process does not eliminate emotion, but it stops emotion from being the sole decision maker. Raj's example shows how this plays out in real life. He had a 3-year growth idea, but he was checking prices several times a day. So 2 normal down days felt much more serious than they really were. His anxiety rose, and he started to question whether he should sell. Instead, he followed a 24-hour rule and waited. By the time he looked again, the stock had rebounded, and the earlier drop fit more naturally into the longer-term picture. What had seemed alarming up close turned out to be ordinary noise in context. When Raj limited checking, the benefits were both emotional and mental. He set one reminder for just before the market close and gave himself one 5-minute review after the day ended. That meant no more intraday refreshing and far fewer chances to overreact to small moves. Almost immediately, his anxiety about temporary price changes fell. More importantly, he was able to think more clearly about the business itself, rather than about every wiggle in the chart. Less monitoring did not make him careless. You can test this with a simple 7-day practice. For 1 week, check your portfolio only once each day at a preset time. Remove easy triggers like alerts, widgets, and unnecessary notifications, so you are not constantly pulled back in. Each day, record the price, the number of urges you resisted, and how you felt during the process. At the end of the week, reflect on what changed in your anxiety, your focus, and your temptation to trade. Small experiments like this make behavior visible, and visible behavior is easier to improve. The most important thing to remember is that this habit is built through repetition, not perfection. A quick peek may seem harmless, but it still reinforces the reflex you are trying to weaken. More monitoring does not guarantee more safety, because price movement and business value are not the same thing. If you slip and check too often one day, do not turn that into an excuse to give up. Restart the next day and return to the plan. Progress here comes from reducing unnecessary checking over time. A conviction trade is not simply a trade you feel strongly about. It is a trade built on a clear thesis, with a defined time frame, and a reasoned expectation for why it might work. That makes it very different from reacting to flashing prices, dramatic headlines, or online excitement. Conviction comes from preparation, not adrenaline. You know what you are buying, why you are buying it, and how long you expect the idea may need to develop. Without that structure, what feels like confidence is often just enthusiasm. Patience matters before entry, because a good idea and a good entry point are not always the same moment. You may identify a business or setup you like, but the price can still be too high, the risk unclear, or the conditions incomplete. Markets also create false urgency through headlines and sudden moves that make it feel as if you must act immediately. Discipline means being willing to let the idea sit there until your actual setup appears. Waiting protects the trade from becoming emotional before it even begins. In many cases, patience before entry matters just as much as patience after entry. One practical way to wait better is to use a pre-trade checklist. Keep it short, maybe 2 or 3 conditions, but make every condition specific and observable. For example, you might require the price to be in a target range, cash to be reserved, and one confirming business or market signal to be present. If one of those pieces is missing, you do not force the trade. You wait or skip it. Later, review whether you followed the checklist, because consistency matters more than whether any single trade worked. A 24-hour rule is especially helpful when the urge to trade feels urgent. If you suddenly want to buy or sell, pause for a full day before acting. During that time, write down the ticker, your entry idea, why the trade appeals to you, and the intended time frame. This simple exercise reveals whether the trade is grounded in a real plan or just in excitement. If the idea still makes sense tomorrow, it may deserve more attention. If the urgency fades quickly, that tells you something useful too. Another strong tool is a written price anchor. Decide your entry price before the market gets there, and define a narrow, acceptable range around it. That way, the market has to meet your terms instead of you reacting to every move it makes. If price stays outside the range, there is no trade. If it enters the range and your other conditions are met, then you act. This reduces chasing and turns waiting into a concrete discipline rather than a vague intention. The written anchor keeps your attention on your plan. Waiting becomes easier when you understand what usually breaks your patience. Some people chase after price surges because they fear missing out. Others feel pressure from news, social media commentary, or the excitement of seeing other people act. These triggers create urgency, but urgency is not evidence. Once you can name the trigger, you can attach a rule to it, such as waiting 24 hours after a spike or ignoring social feeds before making a decision. Self-control improves when vague temptation becomes a recognizable pattern. The goal is to make waiting a repeatable process rather than a heroic act of willpower. Start with one trade idea and a clear thesis. Define 2 or 3 entry conditions. Then begin a 24-hour waiting period before doing anything. After that pause, review the idea and choose one of 3 outcomes: trade, keep waiting, or walk away. Having those options defined in advance matters. It reminds you that not trading is a valid outcome, and that walking away can be just as disciplined as entering. The shoe example shows how process protects you from impulse. The plan was to buy near $40 with a 6-week time frame, and the checklist included price, insider activity, and available cash. When the stock reached the target range, the trader still did not act immediately. A 24-hour pause came first, and only after the conditions still held was the trade placed. That may feel slow, but it is exactly what conviction looks like in practice. The discipline was not about saving a few cents. It was about proving the trade still belonged to the plan. Passing on a trade is sometimes the most disciplined outcome available. If price runs away from your entry, chasing it usually means abandoning the plan in favor of emotion. The same is true when your rules no longer fit, but your opinions still want the trade. Waiting is healthy when it follows structure. Hoping is different. Hoping ignores the structure and clings to the story. A missed trade can feel frustrating, but a forced trade often costs more than the opportunity you think you lost. Patience only improves decision quality when the rules around it are clear. One common mistake is making checklist conditions so loose that they approve almost any trade. Another is ignoring the intended time frame and drifting into decisions the original plan never supported. Watching price too often can also wear down discipline and create the urge to act just to relieve tension. And perhaps most dangerous is refusing to walk away when the setup fails. Good patience is not passive, it is selective, and it knows when not to participate. A commitment device is something you put in place ahead of time to protect yourself from your future emotional self. Its purpose is to make a bad impulse harder, slower, or more inconvenient to act on. That could mean a waiting rule, an approval step, or a practical barrier that creates delay. The key is that you choose it while calm, before stress or excitement arrives. Commitment devices do not help you predict markets. They help you avoid rushed decisions when fear, greed, or boredom threaten to take over. Friction helps because many costly mistakes happen very quickly. Panic selling during a market drop, chasing a stock after a hot tip, buying more just because prices are rising, or trading out of boredom can all happen in minutes. Even a small inconvenience can interrupt that momentum. If you have to wait, take extra steps, or move to a different device before trading, the urge often weakens enough for reason to return. You can still act if the decision truly makes sense. You just cannot act instantly, and that is often the protection you need. There are many ways to build commitment devices into your investing life. Some are account-based, like daily or monthly trading limits. Others create cooling-off periods before certain trades can be placed. Some reduce access by removing trading apps from your phone or making trades possible only from one location. Automated investing into diversified funds is another powerful device because it shifts action from impulse to routine. And for larger or riskier trades, some investors add accountability by requiring a conversation or sign-off from another person. These devices work by adding one or more types of barriers. Time barriers create delays before orders are placed or executed. Effort barriers add extra steps, such as logging in from a computer instead of tapping a phone. Money barriers raise the cost of frequent trading, which makes impulse more expensive. Accountability barriers require someone else to know about or approve the decision. A useful device does not need to block all action forever. It only needs to interrupt the fast path from emotion to trade. The most effective devices are designed around a specific behavior, not a vague hope to be more disciplined. Start by naming the exact action you want to control, such as panic selling after a 5% drop or buying after reading social media hype. Then match the barrier to the behavior. If the problem is fast selling, a waiting rule may help. If the problem is convenience, reduced access may work better. Set it up before emotion arrives and make it inconvenient enough to slow you down, while still reversible if facts truly change. A commitment device becomes stronger when it includes accountability and regular review. Tell someone your rule in advance, because visible rules are harder to break quietly. For certain trades, you might require a check-in or a brief approval conversation first.
Then revisit the device over time and ask whether it is working. If you are still trading impulsively, the barrier may be too weak. If it blocks thoughtful decisions that your plan would support, it may be too restrictive. The best system is not the strictest one, but the one that fits your habits and improves your behavior.
Priya's example is a good model of targeted design. She noticed a recurring pattern. After sharp price drops, she felt an intense urge to sell immediately. So she built a device specifically to slow that reaction. She asked a friend to reinforce her sell rule, enabled a 48-hour delay on sell orders, removed the brokerage app from her phone, and made trading possible only from her laptop at home. None of those steps predicted what the market would do next. They simply made panic harder to turn into action. What Priya's system accomplished was not brilliance, but pause. A 7% drop triggered the familiar urge to sell, yet she could not act immediately from her phone. That alone disrupted the emotional pattern. During the waiting period, the intensity of the fear came down, and she no longer felt the same pressure to do something right away. As a result, she avoided locking in a loss that would have come from panic rather than from analysis. The device did exactly what it was supposed to do. It created time for better judgment. Commitment devices come with trade-offs, so they need to be calibrated carefully. If they are too easy to bypass, they offer weak protection and become more symbolic than useful. If they are too broad or too strict, they can prevent thoughtful action when circumstances really do change. Another common mistake is waiting until temptation arrives before trying to design the rule. By then, emotion is already in charge. Willpower alone is rarely a reliable system. A good device hits the middle ground. Enough friction to slow impulse, but not so much that it blocks deliberate decisions. A practical way to use this idea is to build one commitment device into your trading plan for the next 2 weeks. Start by writing the exact behavior you want to stop, such as buying on hot tips or panic selling after sudden drops. Choose one device that matches that behavior and describe how it will work in plain terms. Set it up immediately while your mind is calm. Tell one person who can reinforce the rule, and then review the result after 2 weeks. If it was too weak, strengthen it. If it was too restrictive, adjust it. Present emotions usually win because they feel urgent and vivid, while future goals often feel distant and abstract. A market drop can trigger panic right now. A tip or a fear of missing out can make action feel necessary right now. By contrast, retirement, a home purchase, or financial independence may matter deeply, but they can feel blurry in the moment of temptation. When one side is emotionally intense and the other is vague, the intense side usually wins. Visualization helps by making the future feel more real while the decision is still happening. Visualization supports self-control by giving discipline a purpose you can actually feel. Instead of merely resisting an impulse because you know you should, you connect today's restraint to a future experience that matters personally. That future becomes more concrete, more emotionally meaningful, and easier to remember under stress. As a result, attention shifts away from the short-term urge and toward the reason you are investing at all. The impulse does not disappear, but it loses some of its dominance. Long-term thinking has a better chance to catch up. Vague goals are weaker because they do not give your mind much to hold on to when emotions rise. Saying, "I want to buy a house someday," may be sensible, but it is abstract. A more vivid version might be imagining yourself unlocking your own front door, walking into your kitchen, and sitting down at your own table. That kind of sensory detail makes the goal easier to recall and more motivating under pressure. The more real the destination feels,
the more influence it can have during moments of temptation. Specificity gives the future emotional weight. To build a useful visualization, choose one goal that is several years away and genuinely matters to you. Keep the focus narrow rather than trying to imagine every financial goal at once. Then turn that goal into a short scene with sights, sounds, feelings, and perhaps other people who matter in that future moment. Write it in the present tense so it feels immediate. For example, instead of saying, "I hope to retire comfortably," you might write, "I am reviewing my retirement income plan with my partner and feeling calm because our bills are covered." Brief but vivid works better than long and generic. This technique becomes practical when you attach it to real decision points. Keep the script somewhere easy to access, such as on your phone, at your desk, or in a note you review before checking your portfolio. Read it daily or weekly so it stays familiar. Most importantly, use it right before moments when emotion tends to take over, like before a trade or after a sharp market move. Then ask a simple question: will this action help or hurt that future? Even a 15-second pause can interrupt emotional momentum and restore perspective. Maya uses this approach during market declines. She wants to retire at 58, and she has a detailed image of a quiet lakeside life that represents what her investing is meant to support. When the market drops sharply, she still feels fear and the urge to sell. The visualization does not erase that fear, but it reminds her that the drop is temporary, while the goal and plan are still intact. Reading her script helps her shift from panic to perspective. Because of that pause, she avoids a hasty trade that would pull her away from the future she actually wants. It is important to be clear about what visualization can and cannot do. It can reduce impulsive reactions, keep your goals visible, and support long-term focus during stressful moments. But it does not guarantee good outcomes, and it cannot rescue a poor investment process. It will not fix weak diversification, excessive risk, or unclear rules. Think of it as one part of a broader self-control system. It works best when paired with sound investing habits, not as a substitute for them. Most mistakes with visualization come from making the goal too abstract or using the method inconsistently. If the goal stays vague, it will not compete well against strong emotions. If you write the script once and never revisit it, it will not be available when you need it. Another mistake is focusing only on fear, such as imagining losses, instead of visualizing the future you are trying to build. And if you rely on the script without having an actual investment plan, the tool has very little to support. Visualization is strongest when it is specific, repeated, and connected to action. A simple exercise can turn this into a usable habit. Choose one goal that is at least 5 years away and spend 2 minutes imagining the moment in as much sensory detail as you can. Where are you? Who is with you? What do you hear? And how do you feel? Then write a short script of 4 to 6 sentences in the present tense. Keep it somewhere visible and read it before acting on an impulse to trade, spend, or panic. When the destination feels real, waiting becomes easier, because patience is no longer just restraint. It becomes loyalty to a future you can clearly see.